Welcome, everyone, to this Legal Office Hours webinar. Today's topic, overcoming common deal sticking points. My name is Will Smith. I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsor-led acquisitions. Attorneys James David Williams and Bill Barlow are going to host today's session. You know James David and Bill. They're partners in Barlow and Williams, a practice that specializes in small business M&A. They're at the front lines of our market. Their focus is helping searchers and independent sponsors like you all get your deals done safely and to your advantage. They also represent sellers, so they see both sides of the transactions in our market. They will do their presentation first, and then we'll do Q&A after. But as you have questions, feel free to ask them as we go. Sometimes we'll interject with a question. Use the Q&A button there in your Zoom to submit those questions. If you have a very involved question, those sometimes aren't right to ask here live. But if you put it in there and it doesn't get answered live, James David will do his best to follow up with you and answer it offline. Just make sure you're not logged in anonymously. He can't follow up with you if you've logged in anonymously. We are recording today's session as always, so either later this afternoon or tomorrow, you'll get a link to the recording and to James David and Bill's slides. And finally, here in the chat are contact information for James David and Bill. Click that top link to go to the Barlow and Williams website and connect with Bill and James David on LinkedIn. Their LinkedIn links are there, as are their email addresses. And Bill, James David, over to you guys.
All right. Well, thank you very much, Will. As stated, we're Barlow and Williams. This is all we do is mergers and acquisitions in the lower and lower middle market. Just to give you a little bit of a sense, what we are going to cover today is, as you know, we've seen hundreds of deals, and we see what are the areas where there's tension between the buyer and the seller. Something comes up besides just sort of price. Something comes up and the seller is upset or the buyer is upset. There's tension there. How do we make sure we move past those deal sticking points? I'll say as a preliminary matter, there are some sticking points that shouldn't necessarily be overcome, right? There are some things that are deal breakers that, it turns out the parties are just too far apart on, so you shouldn't force a deal. But there's most of the time when we come to these things, there's things that create tension, and there are tools in the toolbox to release the tension in the way that works for both the buyer and the seller. And so our job today is that we want to help expose you to some of those tools in the toolbox so that when you come across those situations, you will understand how you can approach it in a way that still serves your interest, but hopefully gets you over that hurdle with the seller.
So we'll start with the most common, I guess, or most common way deals die is financial diligence. So this is why you do this first. But what happens when your QOE comes back and the numbers in the QOE don't match the numbers in the SIM? It could also be that there's big customer concentration, but say the number, and if the numbers are off by 30, 40%, then the deal probably falls apart. But if the numbers are off by 15%, 10%, 15%, right, what happens? So it could be that you had already baked that assumption in and priced your offer accordingly, and you just proceed, right? Some people will do that. If you are going to adjust the terms of the offer based on financial diligence, sellers and brokers will call this a retrade. I don't, that word, it tends to be pejorative in these markets, but buyers and sellers both do it. I don't use the word myself, but so be it. But a few things you can do if the numbers are soft. right? The most obvious is to lower the purchase price, right? But, or the headline number when I say the purchase price. But it could be that the headline number is what the seller really cares about, in which case you might want to consider these other levers. So what you want to do first, and this is a tip, right? Figure out what matters most to the seller. Does the seller care most about the headline purchase price? Is it the cash at close? Is it the potential of, right, the earnout? Like what is it that the seller cares about most? Because you can use that to push on the other areas in order to get to the outcome you want. So we could shift money from close to a seller note. We could make, add an earnout if we're dealing with outside of the SBA context, if we're in independent sponsor territory. If we're in the SBA context, we could make some of the seller note or all of the seller note contingent upon, achieving continued levels of historical metrics. There are limitations to that based on underwriting, but that is something you can do. And another thing you can do is just adjust the working capital target, which effectively adjusts the purchase price. But now sometimes sellers don't think of it that way.
And the other thing I'll say about that is that this can apply to a range of different issues that could potentially impact valuation. So this could also be seller dependency, some other relationship that you didn't understand, anything that materially decreases the value to you of the business. These are kind of the levers you can get to kind of take some of that value back. The next thing, and frankly, this is one of the most irritating for us, is if legal diligence forces a change in transaction structure. Why this can especially be a problem is because the seller might have accepted your offer and said, I need this type of transaction structure for it to work for me. And you might have said, okay, I can work with that. But then you go in and you do diligence and it turns out that doesn't work. Or more commonly, it's actually the opposite. You go into it and saying, hey, I'm doing an asset purchase. I need to depreciate the value of these assets, right? And then it turns out that there's something about the business that doesn't allow you to do that easily. There are key customers that it would be very difficult to assign contracts to. Sometimes you can even have key vendor or supplier agreements. So what you want to do is make sure you focus on that early to make sure that you're not switching midstream. Because when that happens, again, it introduces tension, and either buyer or seller can be wary if it changes the tax treatment for them. And so one of the tactics here is if you have to have this conversation with the seller, you say, look, my offer was given an assumption that I was going to have certain treatment in terms of tax treatment and other stuff. If that's not on the table and therefore, my cash flows are lower, then I have to adjust the offer accordingly. And that way, if it comes up later, it's not so much of a surprise. The other thing I'll just mention is occasionally it will come up that there's some legal diligence item. A common thing is you run a litigation search and it turns out there's some lawsuit. We had this happen in a deal last year. There was a lawsuit that the seller had been named in. They just hadn't responded to it because they were kind of a subcontractor in this broader dispute about a construction. And it was still outstanding and they hadn't replied to it. And so in that case, well, what do? Do you simply not do the deal? Well, we, in that case, found that what we did instead is we had a special indemnification where we said, look, anything related to this matter, the seller has to provide indemnification for. We also had a separate indemnification escrow in that case, which would only be released once the matter was fully resolved. So when things come up in legal diligence and you know that there's a potential problem, special indemnities is a common way of overcoming that issue going forward.
Everyone's favorite topic. I'm getting all the financials today. Working capital. So working capital is one of those things that leads to a lot of misunderstandings, a lot of frustration. We did a whole webinar about this on our last webinar, just on this topic alone. So what you want to do as early as you can is establish a framework or a shared mutual understanding with the seller of what counts for working capital and how are we going to calculate it. Because some sellers assume like they take inventory out for whatever reason, or some people, right? It's like I earned that money, so the AR is mine. These are the sorts of things that happen. And what you want to do as early as you can is get to a methodology and then a calculation period, whether that's an average of the trailing 12 months or the high water mark, or right, if it's a seasonal business, maybe it's what it was this time last year, or whatever the needs be. And this is one of the things you work with your a lot of QOE providers help with this. But what the key is in the negotiations with a seller is you want to deflect as much of this conflict onto your advisors as you possibly can. Because when you're having these conversations with the seller, it's often still relatively early in the process of negotiating. Sometimes this often this negotiation will persist until right up until closing. But you want to deflect blame, right? You don't want to use all of your relationship credits on working capital when there are other things in the deal. So what that means is you blame the accountants, you blame us, you blame anybody else to keep that seller relationship. And sometimes it helps to pull out the spreadsheets with the seller on this, and it's like this is what the cash flow is going to look like. These are my loan payments. This is why I need this AR, right? Because if I don't get this AR, how am I going to be able to pay payroll for the 3 months after closing or whatever the case may be? So sometimes actually getting an Excel spreadsheet helps with working capital. Other times, sellers just throw their hands up and don't understand, in which case you need to be ready to fight against the broker, because some brokers will just tell you, oh, just get a working capital line from your lender. And you should do that, but you shouldn't have to rely on it. Because if you do, then your margin of safety decreases. And I don't love that for buyers.
Can I just plug your last month's webinar? You mentioned it, James David, that it was on working capital, but it was specifically on negotiating working capital. So one thing is understanding working capital. Another is making your seller understand it or figuring out a way to negotiate it. And the whole last session was devoted to negotiating, the delicate dance of negotiating this complex topic. Highly recommended. Just put a link to it in the chat. Carry on.
This next point is a very common sticking point. A lot of times sellers really don't want to have the buyer speak to their employees because they don't want the employees to know that an acquisition has happened or is happening until it closes. Obviously, though, this can be a problem for you. You want to be able to speak to the employees as soon as possible. And, you also, in many cases, there are key employees that you have to have employment agreements with before you close. So if there's a key sales guy, a key operator, somebody that the business really can't run well without, you'd be in a really hard situation if they either left, or especially if they left and started their own company or left for a competitor. You need to have those agreements nailed down before closing. So once again, this is a good conversation topic to have early on, which is when are we going to talk to employees and which employees? Because oftentimes you'll stagger it. There's some employees you need to talk to early, and there are some employees that can basically wait until right before closing. And you also basically treat key employee retention as a closing condition. A lot of times these are sign and close deals, but what you're signaling here is, look, I'm not going to close this deal if I don't get employment arrangements that I'm comfortable with at least these key employees. Another tip is to have these agreements with the employee signed prior to closing and have the seller be there to help provide the introduction. Something else I'll say is that the sellers often have a very good sense of what will happen if you put certain agreements in front of employees, right? There are some employees that they will take any piece of paper, and as long as they're getting paid the same salary, they will sign that piece of paper. There are other employees where if you put a non-compete in front of them, they're going to freak out and they might have a very negative reaction and really start the relationship off on the wrong foot. So as you're thinking about presenting your options to employees, really follow the seller's lead in terms of what you think is going to be palatable, because you don't want to start off on the wrong foot. And at the end of the day, the most difficult thing usually with the seller is just having the conversations early. And at some point, you just need to push back and say, hey, look, I understand that, but I can't be walking in already closed on the deal and be introducing myself to employees for the first time. That's just not going to work. And so, it's just kind of a delicate balance.
Yeah, and there can also be notice periods or lag time in certain states. We had a closing in Illinois earlier this year where employees had to have a certain amount of time to review an employment agreement before it became effective. Other states have variations on this. So right, if you make it a closing condition, you need to make sure that the discussions with those key employees happen soon enough that you meet whatever requirements there are. Okay, so now we'll talk about sort of indemnification. Generally, we're not going to go into detail in indemnification here. That's a topic that's a little bit like going to the dentist for most people. But what I will say is that indemnification claims become harder to bring successfully once the seller has the money, right? The golden rule of, he who controls the gold makes the rule, or possession is 9/10 of the law, whichever aphorism you want to use. Like, that's a real thing when it comes to indemnification claims. So if we're in the SBA searcher world, most commonly your indemnification is going to be first against a seller note, but you need to make sure that there's proper set-off rights in the seller note if you go that route. That doesn't have to be the limit of indemnification, but you do want that to be an option. And if you're in independent sponsor territory, right, more commonly you're going to have an indemnification escrow that will be open for 12, 18, 24 months even. And there could be multiple indemnification escrows if there are the sort of special indemnities that Bill mentioned earlier. You should expect quite a bit of legalese fighting over set-off mechanics. You probably won't be involved in that directly with the seller. That's usually attorney to attorney, but sometimes sellers will dig their heels in on that also. But what you do want to do to help us in those conversations is to make it clear that the seller note will be subject to set off in your LOI. If we're talking about independent sponsors, it's more assumed that there will be an indemnification escrow. So that's not as critical to put in the LOI, but we're dealing with generally less sophisticated sellers in searcher transactions.
James David, could you define set-off rights?
So a set-off right is when, so let's say an indemnification claim, take a step back. Indemnification claim is what happens when one of the statements or covenants that the seller is making in the agreement turns out to be false and you lose money as a result. So if there is set off in place, we'll just take the seller note example. Indemnification escrow works a little bit differently, but if there's set off against a seller note, what happens is instead of paying that amount from the seller note, you just deduct it from the principal of the note. So you keep the money instead of paying it out. If there's an indemnification escrow, the procedure works differently, and there's joint instructions to release whatever the claim amount is to you as the buyer, and the rest stays in the escrow.
Thank you.
So landlord issues, and there's actually two. This slide is more of assuming the more common case, which is what happens if the landlord is a third party. And there you need to address it as soon as possible because your lender will have requirements. If you're in the SBA, they'll definitely have requirements, and even non-SBA, they can have requirements about what the lease terms look like. Because if you have a location that's critical for the business, then the last thing that you want is to lose that location after a year or have rents increase materially so it impacts your cash flow. So you want to address this as early as possible. It's the seller that typically will reach out to the landlord. And most of the time, in my experience, most landlords are pretty reasonable in terms of saying, okay, this is what we need to do in order to make this work. Occasionally, you will find landlords that will absolutely just refuse to cooperate and they will kill a deal. And so that's why you just want to get that done early, because in that terrible scenario where that happens, you want to know right away, because the last thing you want to do is incur a bunch of other expenses before you get to that point. Sometimes, though, the location is not as important. And even if the landlord is intransigent, you might be able to, especially if this is like a generic office space, you might be able to convince the lender to allow you to basically not have to get the same level of consents and potentially move the location. I'll just also do a shout out for issues that occur when the seller is the landlord. You're basically going to buy the business and then rent from the seller. I think we actually also had like a special real estate webinar recently where we covered some of this. But just know that there's quite a few issues to go about. If the HVAC breaks, does that usually, if it's a small break, that's the tenant that deals with it. But if there's a big break, like the whole system breaks down, that's the landlord has to deal with it. And things can get touchy. They can also ask for a personal guarantee on the lease, which can also get touchy. So those are important issues. If the seller is going to be the landlord, make sure to kind of hash that out beforehand, because we've seen those issues, nearly kill deals, towards the end, because there's a lot of disagreements about what those provisions should be.
Yes, and those can get very contentious very quickly. So if the seller is going to be your landlord, right? There's no deal until there's a complete deal. Don't necessarily think you can finalize one and then do the other. I think there is either a deal or there is not. Because those can be a lot of not fun. And why is just it's an increased surface area of the deal. Right, it's just more things to negotiate, and when there are more things to negotiate, there are more things to get angry about.
Yeah.
So that's sort of how that can happen. And I think we'll put the link to that webinar in the chat also that Bill mentioned. So
Yes, I did.
Okay, non-competes. So sometimes sellers get very prickly about non-competes. Sometimes sellers are under the impression that a non-compete isn't applicable to them because they live in California, for example. So I'll just say, and you should let your seller know if they have that belief, that no matter where you are, if you sell a business, then a non-compete will be enforced against you, even California. So you can disabuse them of that notion. But regarding scope, there are three elements to a non-compete. There's the scope of activities, the length, and the geographic extent. Our general approach is to make a maximalist proposal on all three counts that we think will be enforced. And then if the seller wants to respond to that, then we'll listen to it. What often is the case is that the seller is worried about some other side project or some other business that they already have, in which case you can usually work out a carve out to make everybody happy. If they are pushing back on things more generally, then that can be much more of a yellow flag. If there's if they're pushing, you propose 50 miles and they're pushing it to 20, right? There might be a reason for that, and it might not be favorable to you. So, make the maximalist approach or a proposal and then let the seller respond. But most of the time you can work things out. But if there's a real, like, what are we doing here? Then it's better for you to know that before closing than after. So that's why we take that approach.
Seller note. This is also one of the most contentious issues, and specifically, it's about the personal guarantee. So in terms of the seller note, so the seller note is just the amount that you're going to be paying the seller over time. Doesn't happen on every deal, but most deals have a seller note. And so the question is, what secures the seller note? Now, the default position is nothing, right? You're agreeing to pay them, and in the event that you don't pay them, then they sue you just like any other unsecured creditor. Now, some sellers will say, hey, I want some type of security. Personal guarantee is the one that is, often the most dangerous for you. And the reason is because you might think, well, I'm getting a personal guarantee to the bank. What does it matter? Well, why it matters is that the sellers tend to be a lot more emotional about enforcing the personal guarantees than banks do. And so you're much more likely to have a situation where the seller puts you into personal bankruptcy compared to the lender, or just doesn't want to work with you. So it gives them a lot of leverage. So you should really push back against that. What you can offer is you can offer alternatives. So the best alternative for you is probably to give them an equity security, or a security in the equity of the buying entity. The reason that's the best for you is because your argument is, hey, if this doesn't go according to plan, you basically just get the company back, and now you run it and you deal with it, right? So it kind of makes sense. And importantly, when you do that, it also allows you to refinance, because the alternative is for them to get a secondary lien to all of the assets of the company. We've seen buyers accept that. Just know that if the seller has a secondary lien, secondary to whoever the senior lender is, but if the seller does have a secondary lien on the assets, that means if you go to refinance, let's say you want to refinance into a lower rate, you have to pay off the seller note at the same time. And maybe you don't want to do that because there might be an indemnification claim that you want to set off for, or maybe there's performance-based forgiveness, and the period hasn't been up yet. So it's always a matter of trade-off. And then I think in terms of potential tactics, that's where explaining these things, especially on the collateralization point, once you just explain, hey, I'm not doing this because I want to, screw you over. I want to do this because I have a specific idea that I'm going to potentially refinance and I don't want to be restricted. We find that a lot of times sellers will understand that and be much more sort of, okay, I understand, maybe let's do an alternative arrangement, right? And that's a common thing.
But it is common that sellers choose to die on this hill.
Yeah. And then you have to make a decision.
Yeah. And most people at that point will accept it. But okay. So these next items, happen much less commonly because they only arise in certain circumstances. But there are, right, if you're buying real estate as part of the transaction, then there will need to be a phase one environmental assessment as part of that. There's cost to that. Sellers normally don't make a fuss about paying for a phase one. It's sort of assumed that right, in order to sell the real estate, they'll have to do this. It can become a little bit trickier if the phase one suggests additional assessment is needed, and that calls for something called a phase two report, which is a more detailed level of environmental testing. The phase twos are more expensive. They also take longer, but for purposes of this, they're more expensive. And so because of that, sellers will say, hey, buyer, you should pay for this. Because we're talking, 5 figures in cost here a lot of times for these phase twos. And your response, the tip here is money is fungible, right? Money is just changing hands in this transaction. So maybe you are okay with this bucket, not okay with this bucket, right? We just take from here, take from Peter to pay Paul, or vice versa. But the phase two assessment is easier for you to push back on because you can say, hey, seller, you're going to have to do this for any buyer. So you, seller, should bear the cost of this. That argument is a little bit harder to make for an FRE organization. So that is a tax restructuring that the seller will undergo sometimes if the seller is an S corporation and you as the buyer need to purchase the equity of the business, but want asset like tax treatment. And there are costs associated with just making those mechanical filings. It's a process that takes a few days or a week, depends a little bit on what state you're in. And that transaction, the FRE org, tends to be much more for the benefit of the buyer in terms of shedding certain legacy liabilities and also, obtaining asset like tax treatment. So the sellers are in a stronger position to say, hey, buyer, that's for your benefit. I'll do it, but you need to pay for it. And a lot of times buyers do agree to that. You don't have to. But either way, if you do agree to pay these costs as the buyer, you have the option to make them reimbursable expenses and not pay for them in advance as a way to offer yourself some protection. We had a deal that died at the very last minute where that came into play in a very big way, where the buyer paid for the FRE org and didn't pay for the environmental assessment because of that exact dynamic, or he'd agreed to pay for the FRE org in advance, but the environmental stuff was made contingent. So that can happen. And there can be other things that have these sorts of costs. But don't ask the seller to pay for your QOE, for example. Don't be that buyer. That's not what we're talking about here. We're talking about things that are much further down the line and that are not the sort of things that you as the buyer should just be doing yourself, right? There are things that are more specific than that.
And another thing I'll just say is with FRE organizations and certain other things, sometimes you'll get pushback partly because the seller's attorney might not really understand it and might not feel comfortable. If that happens, sometimes you could say, hey, look, my attorneys know someone they can introduce you to who does FRE orgs all the time, and they can do this limited service, right? So sometimes when sellers have a concern about these things, it's also like they don't really understand how to even do this. And that's where a little handholding can go a long way to say, hey, don't worry, I know this is complicated, but I can get you people that can do it and do it right. So that's just another tip when it comes to these things. Next issue is transition services, where these are the things that the seller will provide the buyer post-closing. And it's not uncommon for there to be different ideas about what the post-closing relationship looks like in terms of sometimes the seller expects, hey, I'm going to get a full salary for a year at a pretty high rate. And that I'm baking that into my agreement. Other times the sellers are like, as soon as the deal is done, I am running to the beach, right? I will be doing nothing more, right? And so you have to make sure that both sides are on the same page in terms of expectations. And include that. It's nice to include that in the LOI because this can oftentimes be something that actually becomes an issue one way or another when it comes down to it. Another thing is, what's their hourly rate going to be or other salary compensation. And oftentimes, especially in SBA deals, you can't employ the seller. They can be an independent contractor, but that has to only last for 12 months. And since they're an independent contractor, they can't be on the company's health insurance. And that is often actually a pretty big expense for a lot of sellers. And so, an LOI stage, they might say, buyer will cover seller's health insurance for a year. And you might have to push back on that and say, look, like, I just can't do that under the rules. I can give you a stipend to help you pay for your own health insurance, but then you have to factor all that into the model. Other things here is minimum hours guarantees can be a deal sweetener. So remember we were talking earlier, there's like different levers you can pull as part of the sort of the trading that goes on. One of them is if you say like, hey, I'm going to pay you $10,000 or $20,000 or whatever it is a month for the next 12 months, that's real money in the seller's pocket. And if that's sort of guaranteed to continue for a year, that might help them overcome some other issue like the fact that you're getting working capital or a higher net working capital target, something like that. So another thing just to keep in mind is oftentimes it's helpful to say to the seller, look, I'm not going to require you necessarily, like let's say I say you need to work for 20 hours a week. I'm not necessarily going to require you to do 20 hours a week every week. That might be just what you're available to do, right? Because I don't know, especially at the beginning, how much I'm going to need. But hey, if I don't need you, I don't need you. But I want to know that you're there if I need you. And for sellers who are looking to really back away from the business, that could be helpful because they're like, oh, okay, well, I expect that you're not going to need me as much at the beginning or as much eventually. And so I'm more comfortable giving you those hours because I understand that it's more an availability requirement as opposed to you have to come into the office and always work 20 hours every week.
Okay, so that ends the main presentation. As will look at the questions and start to queue those up. I'll just say we're Barlow and Williams. We are the whole team is on this webinar. When you work with us, you work with us. We use flat fees, milestone-based payments for all of our engagements, and at this point, M&A is all we do. So I'll hand it over to Will, and we look forward to your questions.
Thank you, guys. Great presentation. This is one that you've done once a year for the last couple of years, and you refine it, and it keeps getting better. So I love this. I love the coaching in negotiation. Great stuff. Let's see here. All across the board, these questions. Did you say? Okay, so on landlords, do you typically see a personal guarantee if the seller is your landlord? Do you typically see a personal guarantee in the lease if the seller's the landlord? You do commonly see this in commercial landlords.
Yes. Normally, if you are in the SBA context, you're right, you're setting up a new entity to make the acquisition. Your assumption should be personal guarantee for the lease, full stop.
No matter who the landlord might be.
You can try it, right? You can push, but you should assume. I mean, if it's a big commercial landlord, there will be a personal guarantee. If it's a seller, you can maybe decide that that's an area you want to push, maybe not, but I would still assume that it's going to be there.
Okay. Great. The non-compete in California, we're getting a question about that. What is the length of it?
I don't know specifically in California. It does change. Florida, for example, I think passed legislation last year that made it to where these could be longer. Um, but in most places, you're looking at a range of 3 to 5 years. But that's something that can be confirmed based on the relevant state laws. Some states do it by statute, others do it by case law, common law. But regardless, it's possible to figure out what the answer is.
Yeah. And I'll just add for California, and this applies to some other states, a lot of the language about there's no non-compete is applying to employees. And so as the seller of a company, they're still bound. And James David covered that as well, but just to repeat that.
Yeah, in California, there is a specific statutory exemption for selling a business. Yeah.
Another non-compete question. How do you think about geographic restriction on a business that may be national? For example, a distributor with customers across the country.
Yeah, if there are customers all over the country, then it should be nationwide. If there are customers all over the world, it could be worldwide.
Yeah.
If there are customers all within one metro area, then it's, within X miles of the main office or the headquarters or whatever. But you tailor it to the business's customers and operations.
Yep. A live LOI here. In my LOI, I have a purchase price that states it was based on certain earnings from 2025 and trailing 12 months. But in the week since, I've learned that the accounting was presented as accrual, but the TTM may have actually been as cash, thereby overstating revenue and earnings. What's the best approach to talking through this? Purchase price change?
I mean, fundamentally, and I'll kind of make this a more sort of generalized statement, if the financials that were presented by the seller are lower than the actual financials of the company, then you need to do usually you need to do a repricing of the deal to reflect that fact. Now, as we said, there are other ways of potentially doing that. But yeah, I mean, this is something where you really want to have a discussion with the accountants, I would say, to kind of get into the weeds of what the difference was and what caused that difference. Because at the end of the day, what you are supposed to be looking at is what are your expected cash flows going forward. And that's what you're buying when you're buying the business, right? And so, and what were the actual cash flows in the past as well? Like that's the kind of ground truth you're looking to go towards.
Yeah, and for purposes of the discussion, talk about multiples. Right? This is why we actually have a multiple number in our LOI template, is to facilitate this. It's like, but you could back into it, even if you didn't have the multiple, you could back into it from the number that you had in your LOI and say, well, I'm still going to offer this multiple, but as it turns out, this number was, right, you said was X, it's actually X minus 50,000. And so we're going to adjust the purchase price accordingly. My offer was and still is this multiple. That's how you frame the discussion. It's not to say it's going to go over well, but that's how I recommend to do it.
Yeah. Yeah. And I mean, I would just add kind of to Bill's point that while it may not go over well, you have confidence in your position here. If the business has less earnings than you thought it did, then then you should pay less for that business, because ultimately that's what you're buying, are those earnings. Couple questions here around the seller note and personal guarantee. James David, you said how resisting a personal guarantee on a seller note should kind of be first your posture, but that you may have to accept it anyway. And I think you said that often people do, and you meant buyers, that buyers often just
buyers will accept it usually in the end.
Okay.
When that happens, it's often the very last thing that gets sorted before everything's finalized, actually. If it is that seller's going to die on the hill situation.
Okay. So to Nicholas here, he meant a buyer. Yeah. Okay.
Yeah, you, the buyer, are guaranteeing to pay the seller the amount that the seller is owed under the note.
Right. And you can push and push, but ultimately it sounds like the general advice is to just accept it if you have to at the end.
I mean,
yeah. If it's going to be an issue for a seller, they're not, right? If they want it to be a real issue, they're not going to budge on it. And you just, right, we explain what the consequences are, and then we use that for other deal points.
Can you restate the part about structuring the seller note to avoid a personal guarantee and enable refinancing down the line?
Yeah, so, obviously, if it's an unsecured note, which is the default, then that's perfect. And if the seller doesn't push back on that, perfect, right? Which does happen. If the seller does push back, then your second position would be to say your seller, your collateral is the equity in the business. And the reason why that's often the best offer is because that will still allow you to have the assets of the business serve as collateral for a loan, which means that you would not have to repay the seller note in full in order to refinance the loan, typically speaking. So that's why that's usually the best secondary position. Now, just like with the personal guarantee, there are sellers that will die on this hill, and then most of the time the buyer will end up accepting that. But that's the first argument you can get, and hopefully the seller understands that and is willing to cooperate.
What is your opinion on a buyer putting earnest money down with the LOI? Should this be the expectation or the exception?
Definitely the exception. So this should be resisted heavily. Oftentimes it comes because brokers are used to it if they have a real estate context. If you do have to have a deposit, then number one, you should ask who is holding the money. It should be an attorney and not just the broker. Number two is it needs to be fully refundable if you decide not to go through with the deal, right? Because if it's not fully refundable, then you are being held hostage to the seller. So look at a scenario where the financial performance is lower than expected and you need to change the purchase price. Well, the seller says, well, I don't like that. And oh, by the way, I'm keeping $50,000 of your money because you tried to change the purchase price, right? That's a terrible situation to be in, right? I don't know about you, but most people can't afford to be paying $50,000 every time they have, the seller $50,000 in addition to all their other costs each time they have a failed deal. And even if sometimes we get deposits that go hard after a number of days, like you have like 60 days and then it goes hard, it gets really annoying because what that means is that a week or 2 weeks before the escrow goes hard, you just have to renegotiate with the seller to push that escrow out again. And all those renegotiations create additional tensions each time. And so it's something you should really resist.
This is kind of an unusual situation. I'm going to try to condense it here, but Charles is asking about the diligence findings topic. Have you seen a situation where everything comes back clean, Q of E, TTM EBITDA as expected, but shows that pro forma EBITDA is going to decline significantly? So more specific, concretely, he's under contract for a $1 million EBITDA distributor and has learned that the last few years of this business have benefited from a big CapEx project at so not so in larger sales than they're going to have going forward. The project just ended last month. It was a project with one of the business's customers. Okay. So sales are basically going to decline. And they can already see that in the year-to-date period. I'm not sure exactly, I guess, why this ties into diligence findings, but how to address that.
I'm not a QOE person, but there can be adjustments for things like that, right? You can have adjustments for, right, that sort of big revenue spike that's not going to be repeatable. In the same way, you can have an adjustment for a big expense that's not repeated. So there can be adjustments that go both ways. And you price it accordingly, right? You're pricing it on a go forward basis. So there's a decent chance that the deal will fall apart because of the spread that will result from that, but you need to price it going forward. What is maybe more common is that the earnings will be kind of artificially inflated as a result of not setting aside capital reserves for things like vehicle fleets that have to be replaced every few years. We've seen there's certain industries where this is just notorious. Deals fall apart because of this. But if the seller is not properly accounting for that because they've been using cash, but you're using accrual. If you're using accrual accounting, you need to be setting aside reserves to purchase new equipment. If they've not been doing that, then their revenue numbers may be higher than reality, and that's maybe more common, but that can be an issue too. And you just need to stand your ground, and normalized earnings is this.
Yeah. And something else I'll just mention for an issue where there's a big project and it's coming to an end. Sometimes a seller will say, well, yes, we're not going to have that project, but I was also so busy dealing with that project that, I was not taking other work that I otherwise would have taken. And so, yeah, we're not going to be that rich, but we're still going to do better than just, the business minus that cost. And so what you can do in that situation is, first of all, you should only pay for the business that you're getting. But you can say, okay, well, I can have a little bit more of a seller note so that if you're right and, there's more business to be had that you were declining because you were dealing with this big project, and it turns out that revenues, are actually decent in the post-closing period and the non-special revenue recovers, then the seller will get more of the purchase price through a seller note. But if that's not the case, then that needs to be forgiven, right? If that baseline truly is the baseline, then that's all that I'm willing to pay for. So that's just another thought.
Let's just say that one again, Bill, because that was really good. Say your purchase price is whatever, $3 million, and you can you're willing to pay more for the business if the normalized revenue does recover after the special project is ended. You could add on another $500,000 in forgivable seller note. And if that comes to pass, the revenue does recover, you're perfectly willing to pay that additional $500,000. And if it doesn't, it's effectively been, it's forgiven and you don't have to pay it. That's actually a very powerful tactic.
Yeah.
Okay.
And
Yeah.
it's like if you seller, if your story is correct, then you shouldn't have a problem with putting your money where your mouth is. So
Yeah.
And you could achieve similar mechanics in non-SBA deals. It just looks different.
it's actually a lot easier. Earnouts, yeah.
Yeah. What were thank you so much. Incredibly valuable as always, says Chris. What were the 3 elements in the non-compete?
Yes, the scope of activities, the geography, the geographic extent, and the amount of time.
Yep. Great. Okay. I'll do one more here, but before we do that, James, David, or Bill, would you guys just say a little bit more about how you work, the milestone approach, and how that's different, and just give us a little more color on that.
Yeah, so we always operate on a flat fee basis. What we do is we have a conversation with people that when they come in to us, it's a deal specific conversation. So usually we're reviewing an LOI together or something like that. And then at the end of the conversation, we will provide a quote and we'll provide a breakdown. There's a certain amount, a smaller amount that gets paid up front because we do our legal due diligence, lien and litigation searches, that type of stuff. Then we typically wait until the financial and business due diligence has been complete. Then we charge another chunk when you say, okay, it's time to draft the purchase agreement and other documents. If you have investors, then we typically charge another chunk when you tell us to start drafting the investor documents. And then we will typically get another chunk at the closing. And so it's meant to sort of track the work streams, but still kind of give you the benefit of a flat fee arrangement. Again, this is always tailored to the individual deal. So when you come to us, we'll have a discussion and we'll get you a quote on that right away.
Great. Thanks, Bill. Good stuff. And last links in the chat, everybody, for Barlow and Williams. Check out their website, connect with James, David, and Bill on LinkedIn, or email them. Last question from Hina. For the working capital peg, if there's pushback from the seller on the approach of how to calculate it based on the end of the month or the middle of the month, and then there's some numbers in there, but the middle of the month you have more lower working capital. I guess the question is if it's tied to the beginning or the middle and one of those favors the seller versus you, how to approach.
I will say, as a general rule, most of the time people like closing at the end of the month. All right. And the reason is because you run payroll, you do a bunch of other things. Most of our deals accountants prefer to do that. At the end of the day, you can say, hey, look, which you set depends on whether we're closing middle of the month or beginning or end of the month. But it's going to be a lot easier to see what the needs are at the end of the month, because most of the time when people are doing their financial statements, they'll do month to month financial statements. They won't do sort of middle of the month financial statements, right? So unless there's I'm a little curious why that's the case in this particular deal, but the general idea is usually, you pay payroll, you kind of know what the things should be at the beginning or end of a month, and you try and kind of align the closing with that. And you could just say, look, it's going to be a lot easier for the accountants to do it that way, because that's the truth. And let's not make life really difficult for our poor accountants.
Great. Okay, everyone. The slides and this recording will be emailed to you later today or tomorrow morning. Thank you for coming. Thank you for your attention. Watch for another webinar from Bill and James David next month. We'll be promoting that in a few weeks, closer to the date. And of course, James, David, and Bill, thank you guys for a meaty, valuable presentation as always. These are just fantastic. Thank you guys very much. Thank you, everyone. This ends the webinar.